All right, welcome everybody. This is You've Got Options for Income Navigator. Today is Wednesday, February 12th, 2025. We are going to dive right in. We are looking at an S&P 500 broken wing income butterfly that we put on 5 days ago. And real quick, we can also look at where we are right now relative to where we were when we took the trade. Essentially, we saw no change in price. Looking at the chart, right? So we were up a little, down a little, up a little. We opened down earlier today, and now we rallied. We're down. I don't know, what are we down? We're down about 13 points on the S&P. So very close to unchanged from where we started this trade 5 days ago. Now, when we took the trade, right, we know what the margin was. We also talked about some potential profit targets. My profit target was, and I said that, if I can get to 5% in about 30 days, I would like to take it off and move on, right? We're going to try to not focus on the why price is doing what it's doing. We would rather focus on what is happening with our trade and see if there are any adjustments we can make to possibly improve our position going forward. So when we took the trade, we started off essentially in the same position where we are right now, right? Our near-term price outlook was neutral to slightly bearish, and you can see that right now we're showing, and this is a 4 lot, right? So this is 4 contracts. So on 4 contracts, we're showing a negative 25 delta reading. One thing I do want to note is that when I log in or when I look at this trade on the Thinkorswim, and I understand that different brokers use different formulas to calculate their Greeks. The 4 lot was not showing me the same exact net delta as Option Explorer does. But in any case, we can see that we started off with net negative delta. 5 days ago, we had positive theta and we were short Vega. We can see that this trade has problems both on the upside and on the downside. And when I say this trade has problems up and down, that is at expiration. Yes, if we take this trade today and then over the next couple of weeks, the market or the underlying asset is running up, yes, we are going to be at a drawdown. And then if the price reverts back to the mean and we get back inside the tent, this trade can go from positive to negative, back to positive. So there's going to be, I guess you can call this P&L volatility, right? You're going to get positive and negative P&Ls throughout the life of this trade. But what I want to point out is that looking at the risk graph, we are going to have problems in this trade to the upside and to the downside at expiration. If we'll let the price go too far away from the tent, both up and down, and we do nothing about it, there is a chance, a pretty good chance, if we do nothing about it, we are going to take a loss. Why? Because if the price runs up and away from the tent, at expiration, all options will be worth nothing, zero, right? Everything will expire out of the money. Let's remember, we paid around $17 debit for this trade to put it on, which means we have $1,700 worth of risk, right? That's a debit that we paid to put this trade on. So $1,700 per one contract is at a potential loss if we do nothing as the price moves away from the tent to the upside. On the downside, we have even more problems. Why? Because at expiration, all options are going to be in the money, right? Which means we can figure out what's our risk on the downside. The difference between the widths of these two spreads, we have a debit spread and we have a credit spread. Let's do some very basic math. Let's look at, right, my short strike is at 6,000. So let's call this point A, this is point B, This is point C. So to figure out our downside risk, we take A minus B, right? And these are our strikes. So the long leg of the put debit spread is 6140. So we take 6140 minus 6,000. That's our point B, right? We have 140 points. That's here. Now to figure out the difference or the width of the put credit spread, we take B minus C. B being 6,000. And our long option on the put credit spread is at 58.30. So 6,000 minus 58.30, that's 170. Right? So we have 170, that's this spread. And the difference between these two widths is 30 points. Right? So 30 points, which means that if the price of S&P 500 is below 58.30 or point C at expiration, right? Anywhere C and lower, all options are in the money. We are out 30 points, right? Because this A, B is fully in the money. B and C is fully in the money. The difference between these two is negative 30 points. So we're out 30 points. That's $3,000. Plus, we paid $17 to put this trade on, right? So 30 points. That's just the difference between these two spreads. Plus, hang on one second. Let me get rid of this. So we have 30 points. That's our risk just from the widths of these two spreads, plus 17-point debit that we paid. That gives us a total risk of 47 points, $4,700 per one contract, right? That's what's at risk on the downside, 4,700. On the upside, the risk is 1,700. 1,700 is the debit that we paid. So on the upside at expiration, we would lose 1,700. On the downside at expiration, we would lose $4,700. That is if we do nothing. So doing nothing is not an option here, right? We know that if the price starts to move outside of the tent, we can A, choose to wait for the price to revert back into the tent, right? And that kind of gives you this false hope, right? Because if, let's say, the price goes up and continues to move up, now you're sitting there scanning the internet for headlines why the market should go lower. And you're going to see some, Trump this and that. And you're going to convince yourself that the market is going to revert back to the mean. But in the meantime, guess what? You're not doing anything, which is bad. Not doing anything is bad, especially as you start to run down on time. When you have some time in the trade, you can kind of, play this wait and see game. It's not as urgent to do something, but the closer we get to expiration and the reversion back inside the tent isn't happening, the more potential problems you're going to have because any adjustments is just going to cost more money. And you probably will end up pushing more risk into this trade to save it. And that kind of gets you into a really bad spot. Same thing on the downside. If the market went down, right? So we were kind of right because the initial price outlook for this trade was neutral to slightly bearish. But if we get a 3-4% push to the downside, and now the price is moving away from the 10 to the downside, while we may not have problems right away, eventually we will, because again, if we move lower, and we stay there, right? We may think that, oh, well, the price is going to come back, everything is going to be fine. Well, what happens if the price continues to push lower? Now you're again scanning, the headlines, looking for something to convince yourself that the market should be trading higher. And that's not a good thing to do. So when we take this trade, our number one outlook, it has to be neutral to slightly bearish. If something changes, we need to change something about this trade. Now, we know that one way we can possibly fix this trade, if we move to the upside, right, we need to at least try to recover as much of the initial debit as we can. And how do we do that? Based on trades that we have done in the past in a similar fashion. And we have one trade that's currently going on right now, right? The easiest way to do it is to roll back the long of the put debit spread, which is essentially the same thing as selling a put credit spread. We know that you sell a put credit spread, you take in the credit up front, but it'll require additional margin. To fix that margin issue on the downside, we also look to roll up the long on the put credit spread to the upside, and that should keep our net or total Reg T margin in check. The way it would look, for example, we can look at this trade as it is right now. Right now, this trade is showing us a net delta of minus 25. Let's say if for whatever reason, right, the market is now turning bullish and we wanted to, instead of getting out of this trade, we wanted to neutralize our delta a little bit, right? We can look to roll all or a part of the long put on the upside down, right? So rolling this 61.40 down to 61.30, it's a 10-point wide put credit spread, which will bring in about $4.90 credit, right? But it'll also increase our Reg T margin. And if we have already exceeded, right, our max allocation as far as the Reg T margin goes, then what we need to do is to fix that. If we wanted to bring the green line back towards the blue line, right, or our graph at expiration, we would just have to roll the downside put maybe up 10 points and see what that looks like. Right, so you can see where by pushing the wings or the long options in on both upside and the downside, we're able to raise the green line, which is the risk graph at expiration. But also you can see that by just rolling the wings on both sides in 10 points, our net delta went from minus 25 to minus 20. So this adjustment will bring in about $3.40 credit, which means that our upside risk is now reduced by $3.40. Our delta is reduced from minus 25 to minus 20. We're also giving up some theta, right? So we go from theta plus 138 to plus 120 or so, right? So we're giving up some potential profit inside the tent in exchange for less risk on the upside and on the downside as well. Right, so that's one way to start to reduce our net exposure in this trade. We wanted to get a little bit more aggressive as far as recovering the initial debit. Remember, we paid $17 to put this on. We need to recover some of that initial debit. Maybe we'll do a little bit more of an aggressive adjustment where we roll the upside longs from 61.40 down to 61.10. So that's a 30-point roll down. As you can see, it'll bring a lot more credit, but it'll also push our Reg T margin from 18,000 and or let's call this 19,000 to almost 22,000. So to fix that, we go back to our downside longs and roll those up. Maybe another. Let's see what another 10-point roll up looks like. See, that green line is back in line with the blue line. So essentially, our Reg T margin doesn't change much. It's a little bit lower, right? About $500 less. But our upside risk is reduced quite substantially. And if you look at the delta, we went from a minus 25 delta to minus 7.6. Right. So there are ways to mitigate and to control our risk on the upside as well as on the downside, except on the downside, the risk initially, the risk is not as great because remember, we started off with negative delta. So if we get the move to the downside in the first couple of weeks, maybe a couple of days, the first week or whatever, kind of what has happened since we took this trade 5 days ago, right? From where we started last week or 5 days ago, the market went up, it went up again, and then it went down. It went down today at the open market was down, and if you had GTC orders to close this trade, you were able to get out of this trade fairly quickly, right? So the downside initially, the downside is not, or the risk to the downside is not as great because we start off with negative delta, so we should benefit from a push lower. But if we put this trade on and the market starts to push higher, clearly our neutral to slightly bearish price outlook is wrong, and we could make incremental adjustments, right, by just rolling the longs in a little bit, right, shaving off some of that initial. So now, if let's say we push the wings in, we flatten out our delta, and we give this trade another couple of days, right? We'll continue to monitor. We don't need to day trade. We don't need to scalp around this trade as much, right? We made an adjustment. Why? Because something changed, right? The price is running out of the tent. So we needed to reel it back in and, right, we pushed the wings in a little bit. We gave up some potential profit in the tent. We took out a big chunk of the upside risk, and now we're waiting. Maybe give it a 2 days, give it a 3 days, give it a week, right? Look at what the price is doing. If we're pushing back into the tent, right, that's okay. We can continue to wait on it because why? If the price is inside of the tent, we have a put debit spread that is in the money, which is working for us, right, in our favor. We know that spreads that are in the money, debit spreads that are in the money are going to increase in value with every passing day. And then we have an out of the money credit spread. And we know that an out of the money short put spread or put credit spread with every passing day as it stays out of the money, it's going to decay. The theta is going to decay and work in our favor. So as long as we're inside the tent, we can afford to sit and wait to see what happens next. We don't need to do anything about it. So really the only time we need to be concerned is when the price is moving outside of the tent. And if we don't see the price revert back into the tent, then we need to take action and look for ways. There isn't, what's the right way to do it? There is no right way to do it. There's different ways to do it. You can add another butterfly. You can add calendar spreads. You can do a whole bunch of things. You can reposition the whole thing, right? So there are many ways you can go about it. I prefer something as simple as just rolling the wings. Rolling the wings, get rid of some of the directional exposure, right? We're still going to maintain some negative delta. And if the following day, let's say we had a big gap down today and then we closed on the highs, tomorrow we're going to gap for, I'm not saying that's what we're going to do. I'm saying if we gap up tomorrow and there's follow through, right? The weak shorts got caught and now they're getting squeezed. Well, even though we still have plenty of time, we can start to look for ways to remove some of that delta. And the reason for that is because with these trades, you can see that, right, we're at 60.55, we're short 25 delta. Well, what about at 6100? At 6100, we're short 28 delta. What about at 6150? At 6150, we're short 28, 27 8 delta. As you can see that the delta is going to our net short exposure is going to increase as not only the price is running up, but also as the time goes. You can see that at 61.50, but 14 days into the future, we went from being minus 28 delta to minus almost 41 delta or so. Right? So leaving the trade alone as the price leaves the tent does not work in our favor. That's why I'd prefer to, act a little bit early. But I must warn you that, acting early is great, but you also don't want to over adjust, right? Don't make adjustments every 5 minutes because you get one candle that's red, one candle that's green. Here is the next headline, right? You felt great about the market 1 minute, something happened intraday. Now the market's pushing lower. You get nervous. You go and you make adjust. Like you shouldn't do it that way. I would probably suggest look at this trade once a day, unless we're moving like 3 standard deviations on the day. That's a lot of speed. And chances are, if we get that kind of volatility introduced, it's probably going to stick. It's not going to stick forever, but it might spill over into the following day. And, market's going to start to get a little more nervous. We might start to see, more of these outside of 1 standard deviation daily moves. So unless we're moving with some kind of speed, I would probably just, look at this trade once a day, check in on it. I know, for example, if I did nothing with this trade today, right? Some of our members were able to jump out of this trade with a nice 5% or maybe a little more, maybe a little bit less return on margin, right? We didn't kill it. We didn't get a 5% return on the entire account unless you put entire account into this trade, which is wrong. But, right, you made some money. Great, right? What if I missed that exit for a $20 credit? Is all lost? I think not, right? Yes, the trade is now only up maybe 2.5%, right? But again, we're inside the tent. What does that mean? That means that if we get a couple of more days of chop, which potentially mean that this put debit spread is going to increase in value, the put credit spread is going to decrease in value since we're long a put debit spread and we're short a put credit spread, net effect for this trade should be a positive P&L, right? We should be able to make some money for as long as we stay inside the tent. And you can see that while we have slightly negative delta, we have positive theta. So theoretically, this trade should or the value of this trade or value of this butterfly should increase to the tune of about $140 for every passing day. And if volatility is going to contract, right? If we stay in the range, we have to assume volatility, implied volatility, is going to fall. It's going to come in a little bit. And we should not only make money due to time passage, we should also make money due to volatility decrease, as the value of all options is going to decrease, but we are short 2 times as many options at 6,000 as we are long at 6140. So the point is that if you missed an exit this morning, it's not a problem. I think this trade has a problem if we start to move. I would probably, mark 6,100 as like my soft, or, just, it's not a line in the sand, but at 6,100, I need to see, what does the chart look like? What's happening? And then, if it's 6,100 or more into the end of the day, if the following day we open up, I'm probably going to take action and, remove some of that positive delta just to see if there's more follow through to the upside. I don't want to flip from negative delta to positive delta, because what happens is sometimes, the market pushes higher, gets everybody fooled, everybody's long, only to reverse and go the other way. So if we're going to flip from net negative to net positive just because the market has moved slightly outside or maybe towards the upside break even, if we flip from net negative to net positive and the following day we get a push to the downside, now we're accumulating positive delta on the way down. Now we have to make another adjustment, and that's kind of goes to the point that I made earlier that, it's very easy to over adjust if we are too reactive to near term price swings. So don't try to make an adjustment with every 15-minute candle, right? At this point, with 44 days, I would probably look at this trade um, once a day, right? Around this time of the day, 3:30 Eastern, it's probably a good time to check in on this trade. And if we're inside the 10, probably just do nothing. If we're towards either side of the tent on the break even point, then consider maybe reducing half the delta. Maybe start to look for adjustments that will kind of remove some of that directional risk. All else, just sit tight, and you have to let this positive theta work in your favor. One way you can maybe set your GTC orders to close. For example, if you put this trade on and now you are ready to, you're not going to add anything to it. You just want to give it enough time for the value of all options to decay to get out with, let's say a 5% gain in this trade. How do we figure out what a 5% gain um, when did we reach a 5%? Well, other than just looking at the P&L, and this software will tell you what current P&L represents in terms of our margin requirement in this trade. But you could also say, all right, if I paid $17 for a broken wing put butterfly where my downside risk or the difference between these two spreads is 30 points plus the debit, so it's $4,700. That's the Reg T margin. That's what you have to put up with your broker. That's your risk, right? $4,700, not the $1,700 that you paid as a debit to put this trade on, but you actually had to put up $4,700 with your broker to put this trade on, assuming your broker only takes buying power for one side of this trade. $4,700 times 0.05, right? So we're trying to make $235 per one tranche or per one contract, right? So $235 divided by 100, that's $2.35. You can add that to that $17 debit. So $19.35 is your $19.35 credit is your GTC sell to close order, right? So if you bought to open this butterfly for $17 debit, you're looking to sell to close this butterfly for $19.35. Right, let me repeat that. So if you get out for $19.35 and you paid $17 to put this on, this will result in a $2.35 profit. $2.35 profit on divided by $4,700 worth of risk equals 5%. Right, so that's a 5% return on risk. Risk being Reg T margin, not your entire account, but Reg T margin. Right, so if you put this trade on for $17 debit last week on Friday, and then you took this trade off this morning for $20, that's a $3 profit on $17 risk. On $4,700. So 300 divided by 4,700, that's about 6.38%. So that's how we arrived at that number, and it's totally fine. I think putting these GTC orders to close. I don't like the idea of putting GTC orders to stop me out of a trade. And again, this is not right or wrong. Right? I don't trade assuming the market is going to go down 50% tomorrow. or 9/11 is going to happen and the market's going to be closed for a week, right? If that's your mindset, it's going to be very difficult to make any money. So you have to assume that, the market, yes, the market can go down quite a bit. Volatility can spike quite a bit, right? It's very rare. So it's real. It can happen. And, in that, at that point, we kind of have to, figure out how to um, manage that crisis. But for the most part, right, I don't set GTC orders to stop me out, because um, a stop order, once triggered, will become a market order. And if we have four legs in the trade that are now, an order sent out at market, I don't want to leave the fill in the hands of whoever on the other side. And, in this case, it's the market makers on SIBO. I don't want them to decide what the market is, and, who's there to guarantee me the best possible fill. Right? You can make it a stop limit order, which means that once your stop is triggered, your limit order goes into effect. But that's really not going to do anything if, let's say, the price for this trade, let's say my stop was, if I was looking to make 230, maybe I'm risking 350, right? As an example. So 350 minus that $17 entry. So maybe my stop trigger is $13.50 credit, right? So if I spent $17, I'm trying to make, $2.50. If the trade, or if this butterfly is now worth $13.50, right? That means I lost 350 on 700. I'm down about 7.5%. But that trigger price at 1350, right, becomes now, if this butterfly is worth 1350 and my stop gets triggered, if I set a limit at 1350, but let's say the price is at 1280, I'm not going to get a fill, and the price, or the value of this butterfly could continue to fall, and I'm still not going to get filled, because again, my stop turned into a limit, and my limit is at 1350 or higher. So anything below that, it still isn't going to stop me out. So I don't really like the stop orders that turn into market orders. I don't like stop orders that turn into limit orders, because it's not going to help me. What I need to do, I know that, right? If the market is down, if, let's say, and this is probably a good exercise for everyone. You know that this trade is probably going to get into trouble if we're somewhere, let's say underneath, 5,900, right? Maybe 58.80. Right, there's a 20-point window where the price is now leaving the tent. Set a price alert, right, on SPX, that if we're below 5,900 or below 58.80, send me an alert. And, once you get a notification, right, once that alert triggers, that you need to go and look at this trade. I don't know what the value of this butterfly is going to be, because we don't know how long it's going to take us to get to this price point or price level. And we don't know, what volatility is going to be like, right? If we get to 5,900 today, right, down, about 3%, we have to assume volatility is going to kick up a little bit. Yeah, this trade is going to be at a drawdown. But if we get to, let's say, 5,900 on SPX, with this trade having only 8 days to go, you could also bump volatility up a couple of points, if you will. But at 5,900, this trade is going to be very profitable. So the difference in time makes a big difference in price or the value of this butterfly. So because I don't know how long it's going to take for the price to get to this 5,900, 58.80 price range, right? Setting stops is kind of it's a pure guess. I don't think that it's a good practice, or at least I don't do it that way. I know that if I set a price alert 5,900 and 5,880, especially in the next couple of weeks, maybe a couple of months, or couple of weeks, or maybe in the next month, that price alert will notify me, and I need to go and see what this trade is worth, or what this butterfly is trading for, and make a decision. If maybe it's at a break even at that point and things look terrible and I want to get out of that trade for maybe a break even, okay, that's fine, right? If you think that we're just in the middle of a pullback, it's kind of a slow drift lower, right? We're not crashing. And maybe you just need to fix your potential delta problem, because between 5,900 and 5,880, as you can see, we're going to start to accumulate positive delta. So maybe you want to even out or flatten out your delta a little bit here. We don't know, right, how fast we're going to get there and what the P&L is going to look like. So we can make that potential decision as far as what to do next, when and if we get there. But one thing we know for sure is that if and when we get there, we need to check in on this trade and figure out if this trade needs any adjustments or any improvements. If we get there slowly and you have a GTC order to close at a profit target, there's a very good chance that it's going to get triggered and you will get filled. Kind of what happened this morning, right? When we opened this morning, I'm going to guess that, volatility didn't, spike a ton or spike a lot, but the value of this put debit spread has increased against the value of this put credit spread to push the T plus 0 line high enough to make this butterfly worth $20. I saw someone got filled at 20.05 or whatever that was. So I think setting GTC orders to close at a profit target is a good practice. Setting GTC orders to close at a stop loss is kind of looking for either a bad fill, or you may not get a fill at all if you're using a stop limit, and then you're going to make excuses and blame the market makers and say that they're out to get us again. But none of that makes anybody money, and I think it's just kind of silly. Right? So for right now, we're just kind of hanging out. If you didn't get a fill on this, that's fine. I think you can still hold on to it. Now, if I was looking to set a new trade, something similar to this, right? Again, we start with what is our price outlook. If you have no opinion, then you probably want to start out as flat as possible. Would I use the same days until expiration, 44 days? I think it's fine. Just remember that, the less time you have until expiration, the more right you're going to need to be, because the more time we have until expiration, the more forgiving this trade is. So less time, which means you're going to get paid quicker, which is good. The flip side, if you want to get paid quick, you have to be better, or you have to be really good at picking direction as to where the market is going to move next. If you're like me and you don't know where the market is going to go next, what you can do is you can say, all right, I'm not going to go with 44 days. I'm going to try to go with maybe 64 days. You can go with 51 days, right? This is not a secret sauce. If you do 64, you're going to win. If you do 51, you're going to lose. It doesn't work that way. I don't care what the gurus out there trying to convince you. That's not how this works. You just have to know that more days means slower decay, which means you have to be in the trade for longer, which means you're going to expose yourself to potential risks for longer, right? These are all negative things. You don't want to stay in the trade longer. You want to get paid quicker. You don't want to expose yourself to the market risks for longer, right? You want to be in the market for as little time as possible. But on the flip side, or the positive to all this, is that your trade is going to be less sensitive, which means you could be wrong initially and you have more time to eventually be right. All right, so there's a trade off. So if I was to look to set up a trade, let's say I said, well, I don't know where the market's going to go next, right? We went up, we went down, up. We're just grinding sideways and I don't expect the market to move for the next couple of weeks. Fine. Let's set up a trade that is going to be more or less neutral, right? And the way I would do it, there isn't one right way and everything else is wrong way, right? The way I like to do it, we can start, dead at the money, which means the tent is going to be right above to where the price is. Or if you have a slight directional bias, maybe to the upside or to the downside, then you can go lower or higher on your strikes. I think that it is easier, right? It is easier to place the trade slightly out of the money to the downside. So I would choose and just follow the same exact process that we did when we set up the last trade. We go slightly out of the money, right? So the market is at 60.45 right now. Maybe we'll go 30 points below market. We could maybe go 20 points below the market. We'll sell two of the 60/20s, right? And then we can go, let's say we go 120 points to the downside. Why 120? Just to make it, a round number on the long downside wing. So if we're short 60/20, minus 120 points, we have to go down to 5,900 for our long put on the downside. And then let's say, so we went 120 points to the downside. Let's look at maybe the upper long 120, maybe 100 points, right? So the difference between the widths is going to be $100. So 60/20 plus 100 points, that's 61/20. Right? So we have a butterfly that has it's made of two spreads, a put debit spread and a put credit spread. The difference between these two spreads is 20 points, right? 20 points. This trade is going for $6.05. So let's round this off to maybe $6, right? What is our upside risk? Our upside risk is the debit that we're paying to put this trade on, or $6 or $600 for one contract. What's our downside risk? Well, our downside risk is the difference between these two spreads. Remember, A, B, B, C, right? A, B, B, C. You compare the two widths. The difference between these two spreads is 20 points plus $6 or 6 points that we're paying to put this trade on. So we have downside or Reg T margin around 2,600, and you can see that the software will spit that number out. All right, so that's $2,600 of Reg T risk per one contract. We start off with very slight negative delta, which means that if today's gap down and then potential rally is a fluke and tomorrow we get more downside, well, this negative delta is going to help us a little bit. What isn't going to help us is the negative Vega, because if we gap down and trade lower tomorrow, volatility will probably rise, and whatever gain we're going to get from negative delta and positive theta will be erased by an increase in implied volatility. And if our trade is negative Vega, if volatility is going to increase, we should expect this trade to lose about $120 for every 1 point that volatility is going to increase. but it's not a big deal, right? Remember, as long as we're in the tent, it's okay, right? We can just kind of wait and see. And this is more of a wait and see kind of trade. We just want to give this trade enough time for the value of all options to decay, and we're short the most decay happens with options that are closer at the money. So we're short 60-20 puts. That's where most of the decay is going to come from. Remember, the put debit spread is going to increase in value with every passing day. So as long as this put debit spread stays in the money, which means that our long option is in the money, our short option is out of the money. The long in the money is increasing in value. The short out of the money is decreasing in value. So the put debit spread is going to work in our favor. The short at 60-20 on the put credit spread is going to decay faster than the long at 5,900. So the put credit spread is going to work in our favor. Combining the two, as long as the price is somewhere inside of these two spreads or inside the tent, the value of this butterfly is going to increase with every passing day. So if we're inside the tent, great. The only time we should really start to get concerned is if we're starting to move in either direction outside of the tent. It's really as simple as that, guys. Don't try to overcomplicate things. Don't look or don't get hung up on, well, you said 56 days. Why is this one 64 days? You can choose where or how many days until expiration your trade has. You can choose how wide or how narrow your widths of the spreads are, right? If you wanted to widen this out a little bit, like if you wanted to trade a bigger size, right? It's say you wanted to do 5 contracts, so 5, 10, 5, but you wanted to, instead of one lot tying up, $2,600, you wanted to make it something closer to 5,000. So essentially, you wanted to double, right? Double the amount of Reg T margin. So instead of forcing yourself to double on the size of the trade, you can just make the spreads wider, right? And this is what it potentially could look like. So instead of doing a long wing at 5,900, maybe we go to, and again, you have to play around with this, right? Move the strikes around. Look at how this is going to change your Reg T margin. Look at how that's going to affect your delta, theta, and just all Greeks in general, right? And as long as, for example, like this trade here, right? I just moved the downside long. Well, you can see our Reg T margin went to 6,600. We're actually not paying a debit to put this trade on. We would receive a small credit. So we have no upside risk, but we have, instead of slight negative delta, we have slight positive delta. And as long as this slight positive delta aligns with your near-term price outlook, if you're looking for a breakout to the upside outside of this consolidation area, is this a bad trade? I don't think so. You have to be aware, right, that setting up this trade this way, instead of what we just talked about, where you're paying a debit and you have slight negative delta, you have more risk to the downside. You have to be aware of that in exchange for no risk to the upside, right? So there's some pros and cons. So you have to set up this trade in a way that it works for you. I really don't like the idea of someone telling me or telling you that, hey, if you want this to work, this is the way to do it. This is the only way to do it. I'm right and everybody else is wrong. Nonsense. Complete nonsense, right? You do what works best for you, and you can set this trade up a million times sideways as long as it aligns with your near-term price outlook, and as long as you have an idea of where this trade makes money, where this trade gets into trouble, how much you're looking to make, and when you need to pull the cord on this trade if it doesn't work in your favor. Right? So I just moved the strikes around a little bit. And you can see, right? It's still a 1-2-1 structure. It's one contract. But I push the longs out away from the center of this tent, right? And now my Reg T margin is about 4,500, right? So the difference between these two spreads is now 30 points, which is $3,000. This butterfly is currently going for around $15. So 30 plus 15 is 45. And that's exactly what we're seeing. Our Reg T margin, 30 difference between these two widths plus $15 debit. That's a $4,500 risk on the downside. We have a $1,500 risk to the upside. Our net delta to start is not -1 or minus, it's actually almost -5. So we're taking a little bit more of a directional risk. Our theta has increased as well. And so did the volatility. We're not so much concerned about the volatility unless, again, you're anticipating some kind of a market freak out. And if that's the case, then you shouldn't be putting on a trade that will benefit from range-bound price action. Right? So you have to understand the context of, if you think the market is kind of neutral to slightly bearish, this is essentially a fairly similar setup to what we did last week on Friday. Now, is this one better than the one that we looked at before? It's not. It's just different, right? Which one is going to work? I think they both are going to work. If the price is going to remain inside the tent somewhere over the next, 7, 10, 15 days, right? This is what this trade looks like. T plus 7. You can see where T plus 0 is. This is where this trade makes money. If we pull back slightly from where we are, or if we are where we are right now, or slightly lower, that's T plus 7. How about T plus 15? You can see now the T plus 0 is a little bit higher, right? So again, as long as we're inside the tent, this trade is going to make money over the next 15 days. You just got to have the patience. And you can see all together, right, these T plus 0 lines over time, right? So the red line is T plus 16. That's what the T plus 0 is going to look like, or that's what it's projected to look like 16 days into the future. This darker gray area is T plus 32. So 32 days into this trade, right? You can see the T plus 0 is going to be really, really nice. And this trade is going to be really, really profitable. The problem here is that, right, we don't know where the market's going to be 32 days from now. If we are right, if you think we're going to consolidate for the next 32 days, or maybe if we go up and down, and then we pull back into the tent and this happens over the next 32 days, this trade could potentially yield a lot more than 5%. Right? So just because I'm looking for the first 5% and get out, that doesn't mean that you can't stay longer and potentially make more. Just have to understand, the longer you stay, the higher the odds that the price is going to move, and this trade could go from being profitable to maybe not so profitable, or less profitable, or worse. It could be at a loss, right? Because again, if we look at the price of the underlying asset, does it always trade in the range? It doesn't, right? There are times where we trade in the range, we can sell off pretty hard, right? We can rally, counter trend rally the other way. These are not good moves for a trade that will make money if we're in a fairly small range, right? There are times where we're just going to kind of drift slowly and then potentially revert back, right? So, there are many ways we can end up in this range, right, over the next 32 days. But I'm not planning on being in this trade for 32 days. I just want to grab the first 5% and get out. Is taking 5% when when this trade reaches that 5% target, is it right to maybe take half the trade off, right? Take half of your contract off and let the rest run? Yes, it's right, as long as you still anticipate some kind of range bound price action. Is it right to, when you get to 5%, maybe roll in the wings and take some risk off this trade? Yes, that is right. As long as you still anticipate some kind of range bound price movement, you're not anticipating a big move up or down, and you're ready to defend this trade if the price starts to move. Because remember, the longer you stay, the higher the risks are, right? So there's a lot of ifs and thens, but the idea is you put the trade on, you want to give it, whatever amount of time. As soon as you hit and make your targets reasonable, right? Just because the software says that, hey, there is a chance that if we let this trade, sit there long enough, we can make 89% return. We can make 150% return. Yes. But to me, anything inside of this tent, anything beyond like 10, 15%, you have to be more lucky than anything else, right? So these super attractive potential returns on risk is just not realistic unless you're trading with money that you're completely ready to lose, right? If you put this trade on one lot, your risk is $4,500. You said, you know what? I'm going to hold this thing until it has 7 days to go. Well, what does this trade look like with 7 days to go? Right? So if you're holding this with 7 days to go and you're somewhere around 6,000 on SPX, yes, you can possibly make over 100% return on risk. But guess what happens if, right, the market moves the following day 2 or 3%, which is probably unlikely, but it can happen, right? This trade can go from being very profitable to break even or maybe even down, right? I'm not interested in that kind of business. So waiting for these super unrealistic numbers is not my game. If it is yours, great. Good luck. I'm just looking for, if I can get out with 5%, good enough for me. I'm just going to recycle. Again, as long as I'm going to put a new trade on, as long as my price outlook remains neutral or at least stable, right? If there's some major news that are coming out, if we're expecting a Fed announcement and you may want to either go light or start off. You can scale this trade, right? You don't have to go all in. For example, if you wanted to put, $20,000 of Reg T into this trade, and each one lot is going to require about $4,500, right? You can go about 4 contracts. So you do one now. Maybe if the trade moves or if the price of the underlying asset moves, you put on another tranche, maybe at different strikes, right? And kind of just blend into this trade. There are many ways to approach this. But again, you have to know your max size, you have to know your price objective or profit target, and you also have to know when you're when it's time to exit the trade at a stop loss, because it just doesn't make any sense to continue to hold and potentially expose yourself to bigger losses than necessary. All right. So I think I'm going to put on another trade probably in the next couple of days. Maybe we'll do it towards the end of this week, right? Today's Wednesday. I'll be back on Friday. We can look at where the market is sometime in the afternoon on Friday and, look to set up a trade. I really, really hope that this clears things up a little bit more and kind of gives you a little bit more insight about how I look at and how I think about these trades. If you have any questions, I would love to hear your questions. You can put them in the chat on Discord. I'll be back on Friday. I see your question, Jeff. I'm going to answer. Is it better to put this type of trade on a slightly up or a slightly down day? Essentially, you want to put this on, and this is probably an answer that may cause more confusion than anything else. But yes, you will get a better entry on a down day because there's more premium available, right? So it's going to cost you less to put this trade on a down day. But if the down day is followed by an up day, do you want to take a trade that starts negative delta and be down money potentially the following day when the market um, goes the other way? For example, think about this. If you put this trade on at open today, right, your whole structure was probably a little bit lower, right? So you got a good price because there was more premium available. But as the market rallied, your negative delta probably ate any of the profits or any of the edge you thought you were getting because you were putting this trade on a down day, right? So I don't know. Maybe there is a study. Maybe there's a way to look at these kind of butterflies. Is it better to do it on up days, on down days? VIX at 18 versus VIX at 15 or 20. Um, I just don't think that I trade big enough to make that small um, um, what's the word I'm looking for? To small that to make that small discrepancy make it worthwhile. I would rather rely on my ability to defend this trade if I'm wrong. If I put this trade on an up day and the following day the market goes down, well, guess what? If I set up the trade where I started off with slightly negative delta, well, the following day move to the downside is actually going to play into my hand a little bit, right? So I'm okay with this. If I put this on an up day and then the following day, the market continues to push higher, well, this trade is probably not going to be in a house of pain. But now I know we're getting closer and closer to the area where I need to make some kind of defensive adjustments, and I'm ready to do it. I know what I like to do. I think I know what kind of um, incremental adjustments I would be looking to make. So I'm totally fine with it. So I'm not going to focus on, picking the entry on a down day or on an up day. I'm just going to get in when there is enough time until expiration and let the market do what it will, relying on my ability to be able to handle this trade. Hopefully that answers your question. So with that said, guys, thank you for joining me. Thank you for your questions and your input. We'll be back on Friday. Have a good rest of the day. Until next time, take care, everybody. Bye-bye.